start the recording. Okay, so you'll see that your module outline has also been loaded onto Blackboard with your assessment dates and the mark breakdown. Have a look at that. It is the same as last semester, where each assessment counts a certain percentage. We'll have 3 assessments during the semester. Let me just open that guide. Okay, so if you go through that guide on Blackboard, it has your assessment dates, and you'll see that there will be 3 tests during the semester, similar to last semester, and the highest 2 marks will be taken, okay? And then you also have each test counting 20%. And then your quizzes counting 10%, and then your exam sessions each counting 25%. Have a look at the breakdown there of your assessments. It is the same as last year, and the timetable is the same as last semester, where you'll have your theory class every Wednesday at 10 o'clock, and your practical class will take place at 3:30 in the afternoon on Wednesday. And then your tutorials will be spread throughout the day. You will receive more communication on your tutorials probably later this week, okay? So have a look at the study guide. Remember also the textbook, you will be referring to the same textbook as last semester, but then you also have your recommended books. So for example, this week we're doing earnings per share. As there is no guidance for IFRS for SMEs on earnings per share, we follow the full IFRS approach for earnings per share. So if you want to have a look at the chapter in your textbook, you will have a look at the chapter in the Grip and Garp textbook. It is chapter 24 in the Grip and Garp textbook. Okay. Let's just have a look. I see someone did ask a question in the chat box. So someone is asking, what are we supposed to prepare for the tutorial? At this stage, the tutorial work has been posted onto Blackboard as well as the practical question. So you can have a look at those questions this week after the theory lecture. And then you can attempt those questions and attend your tutorial next week. Okay. So the other textbook is in the library. I'm not sure if the online version has been made available to you, but there is a copy of the Grip and Garp textbook in the library. With the SAGE, we're still discussing it at this stage, so hopefully we'll hear something soon. Okay, so let's start the lecture. I'm assuming you can all see the slides there. Okay. Just going to close some things on my laptop. Okay, so let's start the lecture. So who of you has heard of the ratio earnings per share? Has anyone heard of earnings per share? I'm hoping you would have heard of this ratio before. You might have covered it previously when you did financial statement analysis, like in CFM, and maybe even in financial statement analysis in financial accounting. So let's have a look at earnings per share. But before we have a look at the earnings per share, one thing I want to point out is that to pass Financial Accounting 3B, you need to work smarter, not only harder. Okay, so I'm not sure how many hours you put in last semester to pass. I'm hoping you had to work a bit and not just wing your assessments, but it's important that you work smart and not only hard, okay? It's important that you use all the materials that we give you, like your lecture slides. It's important that you attend the live sessions that we hold for you so you can engage and ask questions, okay? The little comic cartoon here says, if you're not very smart, it's okay to work harder. Okay, all of you are smart and all of you have the ability to pass this module. So you need to work smarter. You must work hard, but you must also work smart. Okay, so that is what you need to do to be successful for this module. So if we have a look at our learning objectives for earnings per share, the first thing we need to have a look at is we need to understand the purpose of providing earnings per share information. What is the importance of providing this information? Then we're going to have a look at the explanation of the following terms. We're going to have a look at basic earnings per share. This is referred to as EPS in your textbook. Then we have headline earnings per share, we have diluted earnings per share, and we have dividends per share. So we are going to unpack all of these terms. Then we're also going to provide an explanation of the following terms. We're going to look at basic earnings, and we're going to have a look at your weighted average number of shares. So if you think about your ratio for your earnings per share ratio, it is your basic earnings divided by your weighted average number of shares. Now, it's not, we are going to look at situations where we will have to adjust your basic earnings, and we also need to consider if the number of shares changes during the year, we will have to calculate something called the weighted average number of shares in order to calculate the earnings per share. So we are going to have a look at those situations. We're also going to look at the calculation and disclosure of basic earnings per share and dividend per share. So when I asked you, have you heard of earnings per share? Most of you said yes. So you should all know that earnings per share is a ratio, and it is used in the financial analysis of a set of financial statements. Okay, so it is a ratio that you're all familiar with. So what does it show? So it provides a measure of the interest of each ordinary share of an entity in the performance of the entity over the reporting period. Now that sounds very complicated, but if we break down the ratio and we say it is your basic earnings, earnings being some form of your profit, divided by your number of total ordinary shares, you're going to get your earnings per share, and this is basically showing you what the ordinary shareholders, the performance per ordinary share. So it is a widely used tool, and as such there is a standard under full IFRS which details how to calculate it. Okay, so like I said, there is no guidance under IFRS for SMEs how to calculate your earnings per share, but full IFRS, which is IAS 33, provides a lot of guidance in the standard, and it is a widely used tool. So all JSE listed companies will need to follow this. Okay. So there are three types of earnings per share. We have our basic earnings per share, and then we have our headline earnings per share, and then we have our diluted earnings per share. We are going to focus on the basic earnings per share. We will briefly explain how to calculate the headline earnings per share and the diluted earnings per share, and see how these are different to the calculation for the basic earnings per share. So when we look at the basic earnings per share, we need to look at the share of profits for the reporting period attributable to ordinary shareholders. Now, who can tell me off the top of the head what other kind of shareholders do we get? Are all shareholders ordinary shareholders, Or are there other kind of shareholders? Who can tell me what other shareholders do we have besides ordinary shareholders? Okay, good. So we have preference shareholders, okay? But now specifically, when we're looking at our earnings per share ratio, it is the share of profits for the reporting period attributable to ordinary shareholders. So it is not the share of profits for the reporting period attributable to preference shareholders. It is specifically the share of profits for the period attributable to ordinary shareholders. So keep this in mind, because later on we're going to have to consider preference shareholders and how that will affect the calculation for our earnings per share. So the ratio is expressed as an amount per ordinary share in issue during the reporting period. Okay. So, and that explains the ratio really. We're going to take our total basic earnings, which is a function of our profit, and we're going to divide this by the total number of shares in the reporting period for the ordinary shares. Okay. So if we go on, so that the previous slide looked at the basic earnings per share, okay? Like the name suggests, it is basic, it is quite straightforward, okay? We are looking at the share of profits for the reporting period attributable to ordinary shareholders. Then, when we have a look at our headline earnings per share, this is a bit different, okay? Our headline earnings per share, this is the share of the profits for the reporting period attributable to ordinary shareholders. However, this must exclude amounts that relate to the measurements that this must exclude the amounts that relate to remeasurements that do not relate to the operating or trading performance of the entity. So here, you have to understand that your profit is a function of a few things. So included in your net profit in your statement of comprehensive income could be things like profit on sale of an asset. And this is not an operating item. So here, when we have a look at the headline earnings per share, remeasurements, again on a remeasurement of PPE. This will be included sometimes in our profit, but it does not relate to the operating activities. It relates to investment activities. So anything that is included in our profit that relates to investments, this will need to be stripped out when we calculate our headline earnings per share. So our headline earnings per share, this is expressed as an amount per ordinary share in issue during the reporting period. Okay, so when we have a look at our headline earnings, you need to ask yourself, is this relating to an operating or trading thing in the entity? If it relates to investment, then you know you need to take it out of your profit when you are calculating your headline earnings per share. So I have explained some of this slide already. When you have a look at your headline earnings per share, there are going to be amounts that need to be excluded. Okay, so when you have a look at your headline earnings per share, there are going to be amounts that need to be excluded from the calculation of headline earnings per share, which is HEPS, because they do not relate to the operating or trading performance of the entity. So some examples of these items that need to be excluded are profit or loss on sale of fixed assets. So let me ask you, when we sell an asset, perhaps we are selling a machine that we use in our business. If there is a profit or loss on sale of this item, should this form part of your headline earnings per share calculation? Okay, correct. So when we have profit or loss on the sale of an item of a fixed asset, this is not directly This is not directly as a result of the trading of your business. So we need to strip this out and exclude it from our profit when we are calculating our headline earnings per share. We would also need to strip out or exclude impairments of PPE, goodwill, or intangible assets when we calculate our headline earnings per share. Also, if a company has gains or losses on fair value adjustments of any investments or investment property, if that does not form part of the trading of the company, then these amounts would also need to be excluded when we calculate our headline earnings per share. Okay. So that is how you calculate the headline earnings per share. Like I mentioned, we are going to be focusing on basic earnings per share, okay? So we will go through briefly how to calculate headline earnings per share and how it is different to basic earnings per share, but we are going to be going in detail into the calculation of basic earnings per share. So we've mentioned, okay, so someone has asked, what if your business operation is to sell assets? Well, then selling assets is your trade, then you would not strip that out of headline earnings per share. But if it is not your trade, if you are making t-shirts and you have a machine that you are selling and your trade is to make t-shirts, then selling that machine is not part of your trade, okay? But sometimes a company does sell machines, so you could have a company that sells computers. Selling machines is that company's trade, so therefore you would not adjust your headline earnings per share. So it's important to ask yourself, what is the company's trade? Selling this asset, is it part of this company's trade? If it is not, then you would adjust any profit or loss on sale of that asset from your headline earnings per share. But if selling machinery is part of that company's trade, then it is trading, then you would not adjust your headline earnings per share for that. Okay, nice question. So let's carry on. So we've had a look at basic earnings per share, and we'll go into more detail later on in the lecture. We have briefly touched on headline earnings per share. Let's have a look at diluted earnings per share. So diluted earnings per share, here both earnings and the number of shares need to be adjusted for the effect of potential ordinary shares, okay? So what does potential ordinary shares mean, okay? So sometimes there's a contract that entitles the holder to a certain number of ordinary shares at some point in the future, okay? So there are two examples. I'm not sure if you have heard of these, but there can be a situation where there are share options that are available. So when we have a share option, this gives the right to the holder of the option to buy a certain number of shares at a fixed price in the future. Okay, have you heard of a share option? So sometimes employees, if they work for a company for a few years, they could be given share options, and they may exercise these share options. If they exercise these share options, we know that there are going to be more shares, okay? We may also have a situation where there are convertible debentures. Can someone tell me what a convertible debenture is? Have you heard of this term before? Okay, so a convertible debenture is where you have these debentures, but sometime in the future, they may be convertible into ordinary shares, okay? They may be convertible into ordinary shares at some time in the future. Obviously, if this happens, our number of shares could change in the future. So when we have a look specifically at our diluted earnings per share, this takes into account any potential ordinary share that exists, okay? So obviously, if a company has share options, then at some point in the future, these share options may be exercised, and this will result in more ordinary shares. And it's the same with convertible debentures. At some time in the future, these convertible debentures will be converted into ordinary shares, and this will change the number of shares in issue. So diluted earnings per share, it kind of shows the effect of all the potential ordinary shares if the options were exercised and if the debentures were converted. So it is basically diluted earnings per share. Your earnings per share is diluted by all of the potential ordinary shares. Okay, so well done. I see you guys know what a convertible debenture is. So that is your diluted earnings per share. Okay, so it's important that you just understand what your headline earnings per share is and what your diluted earnings per share is. But like I mentioned, the focus of this lecture is going to be on your basic earnings per share. So let's have a look at the next slide. So the next slide basically shows you your calculation for your earnings per share. And you said you were all familiar with this ratio, but let's just recap, okay? So the earnings per share ratio, specifically the basic earnings per share ratio, is calculated by taking your basic earnings and dividing it by your weighted number of shares in issue during the reporting period. Okay. So it sounds simple, and on the face of it, it is. Okay, all you need is your basic earnings, and we're going to look at in more detail how to calculate your basic earnings, and when we have situations where we need to adjust our profit to get to our basic earnings. And then once we have our basic earnings, we are going to take this and we are going to divide it by the weighted number of shares in issue during the reporting period. Now, what would cause there? Why would we have to calculate the weighted number of shares? During the year, more shares could be issued. Okay, so if more shares are issued during the year, it means the number of shares we had at the beginning of the year is different to the number of shares we have at the end of the year. So if there is a share issue, then we'll need to take into account the share issue during the year and calculate the weighted number of shares during the period. Okay. So let's have a look at the next slide now that we've gone through the basics of how to calculate the ratio. So here we need to consider, so someone said that they are not just ordinary shareholders, they are also preference shareholders. So how are preference shareholders different to ordinary shareholders? Can anyone tell me, how are preference shareholders different to ordinary shareholders? Okay, so someone has says preference shareholders are guaranteed dividends. Okay. We also have preference shareholders have preferential treatment. That is correct. We also have someone answering that they get their dividends first before other shareholders. Okay, that is correct. So you guys are all correct. Preference shareholders, they have more rights than ordinary shareholders. So in the event that the company is liquidated, preference shareholders are paid first before ordinary shareholders. Okay, so preference shareholders have preference over ordinary shareholders in the event of liquidation and also when dividends are paid. Okay, correct. Thank you all. So when we looked at what the earnings per share was, we said it is the earnings attributable to ordinary shareholders. Okay, so you all said that your preference shareholders have preferential rights to ordinary shareholders, and our earnings per share calculation is the earnings that is attributable to ordinary shareholders. So the starting point for us to calculate our basic earnings in our formula, in our ratio, is to start with our profit or loss for the period. So as you can see there in the calculation of basic earnings, the starting point for our basic earnings is our profit or loss for the period. And this would come from your statement of comprehensive income. But then remember, included in this profit could be those amounts that would be paid to our preference shareholders through the way of preference dividends, okay? And you said that preference shareholders have preference over ordinary shareholders. So do you agree that not all of this profit will be directly attributable to the ordinary shareholders? A portion of this profit, if the company has preference shareholders, would be paid to the preference shareholders first, and then only would the ordinary shareholders get their share. So because the preference shareholders have preference over the ordinary shareholders, if there are preference shareholders and preference dividends in a company, this needs to be taken out of our profits in order to calculate our basic earnings, which is attributable to our ordinary shareholders. Okay. I hope that makes sense, but basically our starting point is going to be our profit or loss for the period. Then we need to have a look at, do we have any preference dividends that need to be paid to our preference shareholders? We will strip that out of our profit and then we will get to our basic earnings. This is our earnings that is attributable to our ordinary shareholders, okay? And obviously, we are taking out our preference dividends because the preference shareholders have preference over the ordinary shareholders. They will get paid their dividend. They have preference to the dividends. They will be paid first, okay? So now that we have looked at the basic formula, let's have a look. There should be a class example. Okay, well, let's just go to the next slide and then we'll go to the class example. Basically explains what we have just said. So why should the preference dividends be excluded from the profits? They should be excluded from the profits in order to get basic earnings before earnings per share is calculated. So we need to take out any preference dividends from the profit in order to get our basic earnings that is attributable to our ordinary shareholders. Okay. So preference shareholders have preferential rights. You guys said that, which was 100% correct. That is, they have to be paid their dividends before ordinary shareholders are entitled to any dividends. So the preference shareholders will be paid first, and then we will see what is attributable to the ordinary shareholders. So the amount left over after we have deducted all the amounts payable to all the preference shareholders, this will be the profit that is attributable to our ordinary shareholders. And this is known as your basic earnings. Okay. So just remember, there are different types of shareholders. We have ordinary shareholders and preference shareholders. When we look at our basic earnings per share calculation, we are specifically wanting the earnings attributable to our ordinary shareholders. So we need to then strip out the amount attributable to our preference shareholders from our profit in order to see what is attributable to our ordinary shareholders. Okay. So let's have a look at the next slide and then we will start our class example soon. So if we have a look at our basic earnings, specifically the numerator, remember in a ratio you have a numerator and a denominator. The numerator in this situation is your basic earnings. So the preference dividend is only deducted from the profit for the period if the preference shares are classified as equity. Okay, so now another thing I need to ask you, when we have preference shares, do you agree that these preference shares can be classified as a liability or it can be classified as an equity, depending on the terms when the preference share was issued? Okay, so do you guys agree that a preference share can be equity or it can be a liability? Obviously, the preference share will be classified as a liability or equity depending on the conditions that existed or the terms when the share was issued. Okay. So the preference dividend will only be deducted from profit for the period when we are calculating our basic earnings, when the preference shares are classified as equity. Okay, so let me ask you this question. When we have a preference share that is classified as a liability, how do we calculate the preference dividend? What form is it in? Okay, when we have a preference share that is classified as a liability, where do we deduct that preference dividend from? Okay, so do you agree that when we have a preference share that is classified as a liability, we are going to use, or the preference dividend is treated as interest, and it is calculated using the effective interest rate method in calculating profit for the year? Okay, this should tie in with the work you cover in CFM, and next week you'll be looking at this in more detail. But basically, when we have a preference share that is classified as a liability, we essentially treat the preference dividend as interest, okay? And this, therefore, the preference dividend, which is treated as interest, this will be deducted from your profit, okay, in your statement of profit and loss or statement of comprehensive income. So do you agree when we have is treated as interest expense? So when we have a preference share that is treated as a liability, do you agree that the preference dividend is already deducted from your profit? So then when we calculate the basic earnings per share, we are not going to then deduct the preference dividend again because it was already deducted from your profit. So for those preference shares that are classified as equity, that preference dividend would not have been deducted from your profit. So when we have preference shares that are classified as equity, yes, in order to get to basic earnings, we would have to deduct the preference dividend from our net profit in our statement of changes in equity in order to get to our basic earnings. Okay, so let's just go through the slide just to see if I have explained it simply enough. But you agreed that our preference shares can be classified as equity or a liability. So when we have preference shares that are classified as equity, then when we are calculating our basic earnings, we are going to deduct the preference dividend from the profit for the period because these preference shares are classified as equity, okay? They would not have been deducted from the profit already. However, if the preference share is classified as a liability, the preference dividends would already have been deducted in profit or loss as an expense. Therefore, we are not going to adjust the profit for the period for the dividends that relate to the preference shares that are classified as a liability. Okay, so we deduct equity. Okay, we're going to get to that later. So later on, we're going to look at the difference between when a dividend is declared and when it is not declared. But the principle I want you to take from this is that you need to ask yourself, is your preference share classified as a liability or is it classified as equity? If your preference share is classified as equity and you have a preference dividend during the year and you want to calculate your basic earnings, for your earnings per share calculation, then yes, you will deduct that from your profit to get to your basic earnings. However, when you have a preference share that is classified as a liability, the preference dividend would already have been deducted from your profit because it is essentially interest. So this would have been deducted from your profit already. So then when you are calculating your basic earnings, you're not going to deduct it again, okay? So let's go to the next slide. This might assist in the understanding for those that are confused, okay? So now we are going to recap. So sometimes we have preference shares that are redeemable, okay? So we've looked at preference shares, and we said that when the preference share is classified as equity, in order to get our basic earnings, when we calculate our earnings per share, we will deduct the preference dividend from our profit. However, when we have preference shares that is classified as a liability, because the preference dividend is already in your statement of comprehensive income or your statement of profit or loss, it has already been deducted. So there's no need to deduct it again, okay? So then now we're going to be looking at redemption of preference shares. So sometimes we will have redeemable preference shares, and these preference shares can also be classified as equity or a liability, okay? So what does redeemable mean? When we have preference shares that are redeemable, what does this mean? Okay, so it's basically the repayment to the shareholders of preference share capital. So these preference shares will be redeemable at some time in the future. The shareholders will be repaid their share capital, okay? So we would have to indicate to you for preference shares whether it is equity or a liability. So this will have to be indicated to you in the question. Otherwise, it's going to be difficult to know how to treat it, okay? So when we're looking at redeemable preference shares, these can be classified as equity or liability depending on the terms of the redemption of the preference shares at the time the shares were issued, okay? So we will have to ask ourselves when the redeemable preference shares are issued, is this classified as equity or is it classified as liability, okay? So we're going to look at the terms. So when we have redeemable preference shares that are compulsorily redeemed or redeemed at the option of the holder, an obligation is created on the issue date. So when we have an obligation created on the issue date, these redeemable preference shares are going to be recognized as a liability. Okay, so when we have preference shares that are redeemed at the option of the holder, then an obligation is created, meaning this is meeting the definition of a liability. So this preference share will be recognized as a liability. However, when we have a situation where the redeemable preference shares can be redeemed in the future or redeemed at the option of the company, no obligation is created on this date, okay? It is not certain that these preference shares will be redeemed. So in this situation, the preference share should be recognized as equity. Okay, so it's important to look at the terms of the redeemable preference shares when they are issued, so we know whether the preference share is equity or if it is liability, okay? So whether the shares are equity or liability in nature, at the time of the redemption of the shares, remember we need to have a look at the Companies Act and ensure that the solvency and liquidity test is met, okay? So next week when you look at this in more detail, you will be going through parts of the Companies Act and making sure that the solvency and liquidity test is met, okay? So someone has asked me to explain the slide again. So remember I said to you preference shares can be classified as equity or liability. So when we have a look at redeemable preference shares, we need to look at the terms of the redeemable preference share when it is issued in order to ascertain should it be equity or should it be a liability. So where we have a redeemable preference share, and this preference share is compulsory, it is definitely going to be redeemed, or it is redeemed at the option of the holder. So the preference shareholder can decide when to redeem it. An obligation is created on the issue date. Okay, so if we have a redeemable preference share, it is compulsory, that is compulsorily redeemable, or it is redeemed at the option of the holder. An obligation is created when this preference share was issued. Therefore, this share is going to be recognized as a liability, okay, because there is an obligation. However, when we have a situation where the preference share could be redeemed, it is not certain, it could be redeemed in the future, or it is redeemed at the option of the company who issued the share, no obligation is created on the issue date. Therefore, the share is going to be recognized as equity in this situation. Okay, so when you have a redeemable preference share, you need to look at the terms when it was issued. Is there an obligation? If there's an obligation or the holder has the option to redeem it, then you're to recognize that preference share as a liability. However, if there's no obligation, then the share is going to be recognized as equity. Okay. And then just something to consider when you have redeemable preference shares. If these shares are going to be redeemed, you need to consider whether the solvency and liquidity test in the Companies Act is met. Okay. But don't worry too much about that. You're going to go through that in more detail in next week's lecture. Okay, so let's have a look at the next slide. So who can tell me if they've ever heard of cumulative and non-cumulative shares? When we have a preference share that is cumulative or non-cumulative, what does it mean? So I'm not sure if you've ever heard of that before, but you can have a cumulative preference share. If we have a cumulative preference share, this means that the company must pay out arrear preference dividends before paying ordinary dividends. So sometimes a company will have cumulative preference shares and they may decide to pass and not pay a preference shareholder. Perhaps they do not have profits. But before the ordinary shareholders can be paid, because the preference shares are cumulative, the company will need to pay any arrear preference dividends out to the preference shareholder. Okay, so that is cumulative. If a company passes and does not pay a preference shareholder and the preference shares are cumulative, any dividend that was not paid in the past, needs to be paid in the future before any ordinary shareholders can be paid. Okay. You have said it perfectly. Cumulative means unpaid dividends over the years must be paid in the year when the company is able to pay the dividends. 100% correct. So if that is cumulative, what does non-cumulative then mean? Okay, if we said that cumulative means that any unpaid dividends in the past need to be paid in the year when the company is able to pay them, then non-cumulative means that any preference dividends that were not paid in the past never need to be paid. Okay. So non-cumulative then is the opposite. It means any arrear preference dividends never need to be paid. Okay. So it's important when we have a preference dividend, we need to ask ourselves, is the preference share cumulative or non-cumulative? So if we have a non-cumulative preference share, only the preference dividend declared is going to be deducted. Okay. So when remember, we are still looking at how to calculate our basic earnings. If we have a preference share that is non-cumulative and no dividend was declared, then we are not going to deduct it when we calculate our basic earnings. However, if we have a preference share that is non-cumulative and a dividend is declared, then yes, we will deduct it. So when we have a non-cumulative preference share, we will only deduct a dividend to calculate our basic earnings if that dividend is declared. Okay, because when a dividend is declared, we know it is going to be paid. Okay. So then if we look at cumulative preference shares, So because they are cumulative, they are going to be paid regardless. The preference dividend does not need to be declared to be deducted when calculating our basic earnings. Okay. So it's important to look at our preference shares and ask ourselves, are they cumulative or are they not cumulative? If they are non-cumulative, meaning any dividends that are not paid in the past will never be paid, okay, then in order to deduct any dividend relating to non-cumulative preference shares, the dividend needs to be declared. Whereas if we have cumulative preference shares, if the dividend is not paid in the past, any arrear preference dividends will need to be paid. Okay, so if we have cumulative preference shares, the dividend will be deducted when calculating the basic earnings, whether they are declared or not. Okay, because we know they will be paid in the future. Okay, is it difficult to understand? Okay, don't stress. We're going to continue with this topic next week, but what helps is if we have a look at some of the class examples. But let's carry on with the slides, and there should be some class examples coming up soon, and we're going to go through it. Okay, don't stress now. It is only the first lecture. We have plenty of time to go through this. Okay. So when we're looking at our basic earnings, okay, I think the best way to remember this is to actually understand it. So you need to understand what cumulative and non-cumulative means, okay? Let's have a look. We're going to look now at redeemable preference shares, and then we're going to have a look at some examples, okay? So this is just a slide to recap some of the previous principles which we have learned. When we have redeemable preference shares, so if we have redeemable preference shares and these are classified as a liability, remember we said if redeemable preference shares are classified as a liability, the preference dividend would already have been deducted from our profit, so there is no further adjustment needed. So when we are calculating our basic earnings and we have redeemable preference shares that are classified as a liability, because the preference dividend would already have been deducted from our profit and loss, no further adjustment is needed, okay? So then when we have non-cumulative preference shares, only the preference dividend that is declared is deducted, okay? So when we have non-cumulative preference shares, only the preference dividend that is declared is deducted, okay? When we have cumulative preference shares, the preference dividend required to be declared is deducted. Okay, so whether declared or not. So when we have cumulative preference shares, the preference dividend will be deducted whether it is declared or not, because it is cumulative, meaning it is definitely going to be paid before any ordinary shareholders can be paid. Okay. There's also on the next slide a diagram that may assist you in understanding this. So when should I deduct preference dividends from basic earnings? Okay. Are the preference shares redeemable and a liability? If the preference shares are redeemable and a liability, then what do we need to do? Are we going to deduct preference shares that are classified as a liability from our profit? No, we do not deduct, and the reason is that the preference dividends would already have been deducted. Okay, so if we have preference shares that are redeemable and a liability, if we meet that and we can say, yes, we have that preference share that is redeemable and a liability, we do not deduct from our profit when calculating our basic earnings, and the reason for this is that the preference dividend would already have been deducted in our statement of profit or loss. Okay. However, if we have a preference share that is redeemable and and a liability. If we say no, we do not have that, then we need to ask ourselves, are the preference shares cumulative? If the preference shares are cumulative, then yes, we would deduct the preference dividend from our profit when calculating our basic earnings. So remember, we said cumulative preference shares, they will be paid, they will definitely be paid even if they have not been paid in the past. So if we have preference shares that are cumulative, then yes, definitely we are going to deduct our cumulative preference dividends from our profit when calculating our basic earnings. If we ask ourselves, do we have preference shares that are cumulative? And the answer is no, meaning they are non-cumulative. So if we have preference shares that are non-cumulative, then we need to ask ourselves, has the dividend been declared? If the dividend has been declared, then yes, we are going to deduct the preference dividends from our profit when calculating our basic earnings. If we ask ourselves, are the preference dividends, the preference shares that are cumulative, have they been declared? If the answer is no, the preference dividends have not been declared, then we will not deduct them from our profit when calculating our basic earnings. Okay. So let's have a look at an example and test whether we understand these principles. Okay. So we have a company here, FAC3 Limited, has 20,000 ordinary Class A shares in issue throughout 2012. The company earned a profit after tax of 200,000 Rand. Calculate the basic earnings per share for FAC3 Limited for the reporting period ended 31st December 2012. So who can tell me what the basic who can tell me what is the basic earnings per share for FAC3 Limited for the reporting period ended 31 December 2012? So remember, we need to consider what is the formula to calculate our basic earnings per share. We need to take the earnings that are attributable to our ordinary shareholders, which is 200,000 Rand, and we need to divide this by our weighted average number of shares. In this situation, they've told us that there are 20,000 ordinary Class A shares in issue throughout 2012. So you guys are correct. The basic earnings per share is going to be 10 Rand per share. Okay, well done. So let's have a look. This example was easy because there were no preference shares. So we have our profit or loss for the period being 200,000 Rand. There are no preference dividends to deduct because the company had no preference shares. So we are simply going to take our earnings attributable to our ordinary shareholders of 200,000 and we're going to divide that by 20,000 being the number of shares in issue. Okay, so that will give us 10 Rand. That will give us a basic earnings per share of 10 Rand per share, or you could give it in cents. So if you are giving it in cents, it would be 1,000 cents per share. Okay, most of you got that, or all of you got that correct. Well done. Let's have a look at the second example now, where it may be a bit more tricky. So here, FAC3 Limited had 20,000 ordinary Class A shares as well as 20,000 non-cumulative, non-redeemable 10% preference shares in issue throughout 2012. So the preference shares all have a face value of 4 Rand each. The company earned a profit after tax of 200,000 Rand. The full preference dividend for the year was declared. Now you need to calculate the basic earnings per share for FAC3 Limited for the reporting period ended 31 December 2012. Okay, so it's similar to the previous example. We have 20,000 ordinary shares, but we also have 20,000 non-cumulative, non-redeemable 10% preference shares in issue. So the full preference dividend for the year was declared. So who can tell me what the basic earnings per share should be? Okay, I see a lot of you getting the answer there. Well done. So let's look at the answer. So we have profit or loss for the period of 200,000. That was given to us in the question. And we need to ask ourselves, these preference shares here, should they be deducted or not? Okay, so these preference shares are non-cumulative. These preference shares are non-cumulative, which means that if the dividend is passed, it does not need to be paid. Okay, they are non-cumulative. So the only way that these shares can be deducted is if they are declared during the year. Were these shares declared during the year? Sorry, were these preference dividends declared during the year? It says the full preference dividend for the year was declared. So even though the shares are non-cumulative, the full preference dividend for the year was declared. Therefore, it needs to be deducted from the profit or loss for the period when calculating our basic earnings per share. So how do we calculate our preference dividend? Let's just go through this. So we have 20,000 preference shares in issue. The preference shares have a face value of 4 Rand. So we're going to go 20,000 times 4 Rand. That gives us 80,000. Then we need to multiply that by 10%. And that will give us a preference dividend of 8,000 Rand. So from our profit or loss for the period, we need to subtract the 8,000 Rand, which is our preference dividend. And the reason we are deducting it is that it was declared, okay? So even though the preference shares are non-cumulative, because it was declared during the year, we can subtract the 8,000 Rand. So that is going to then give us earnings attributable to ordinary shareholders of 192,000. So this is the earnings attributable to ordinary shareholders because we have subtracted the preference dividend. Now we need to divide this by the number of shares in issue. And the question told us that there were 20,000 ordinary Class A shares in issue. So we are going to take the 192,000 and we are going to divide that by 20,000. This is going to give us 9 Rand 60 per share. Okay, this is going to give us 9 Rand 60 per share, earnings per share, or if you want to report it in cents, you can say 960 cents per share. Okay, I see a lot of you got the answer. Well done. Let's go on to the next question and just continue to check whether you have understood some of the principles taught. So if we have a look at the next question, FAC3 Limited had 20,000 ordinary Class A shares as well as 20,000 10% preference shares in issue throughout 2012. The preference shares all have a face value of 4 Rand each. The company earned a profit after tax of 200,000 Rand. The full preference dividend for the year was declared. Okay, so what are we going to do in this situation? Okay, sorry, if we go to the next slide, we'll see that they're telling us different situations. So in one here, we need to assume that the preference shares are non-cumulative and non-redeemable, and the dividend is declared. In scenario 2, we need to assume that the preference shares are non-cumulative and non-redeemable, and the dividend isn't declared. In part 3, we need to assume that the preference shares are cumulative and non-redeemable, and the dividend isn't declared. Okay, so a lot of different situations. Let's go through them one by one. So if we go back to the question, FAC3 Limited had 20,000 ordinary Class A shares, as well as 20,000 10% preference shares in issue throughout 2012. The preference shares all have a face value of 4 Rand each. The company earned a profit after tax of 200,000 Rand. The full preference dividend for the year was declared. Okay. Wait now. So for the first scenario, let's assume that the preference dividends are non-cumulative and non-redeemable, and the dividend is declared. So if we have the situation on the previous slide, and we have non-cumulative and non-redeemable preference shares, and the dividend is declared, are we going to deduct the dividend? Okay, you are 100% correct. Even though the preference shares are non-cumulative, meaning that if the preference dividend is not paid in the past, it does not need to be paid. It's not going to be caught up, basically. But because the dividend is declared during the period, then yes, we are going to deduct the preference dividend. Okay, so in the first situation, we will have profit for the year of 200,000 Rand, less the preference dividend of 8,000 Rand, and this will give us our basic earnings attributable to ordinary shareholders of 192,000 Rand. Okay, so you guys agreed that yes, we are going to deduct the preference dividend. Okay. Then if we have a look at the second situation, we have non-cumulative and non-redeemable preference shares, and the dividend isn't declared. So we have the same situation in the previous slide. We have 20,000 ordinary Class A shares, as well as 20,000 preference shares. They're telling us that these preference shares are non-cumulative and non-redeemable, and the dividend isn't declared. Are we then going to deduct these preference dividends from the profit when calculating our basic earnings? Okay, you are 100% correct. No, we would not deduct the dividend because it isn't declared, and because these preference shares are non-cumulative, the company does not have to pay them in the future. Okay, they do not have to be caught up in the future. So you are correct. We are not going to deduct this preference dividend. So we are simply going to take our profit for the year, this 200,000, and that will become our basic earnings that are attributable to our ordinary shareholders. So if we have a look at scenario 3, here we have cumulative and non-redeemable preference shares, and the dividend isn't declared. So we have cumulative and non-redeemable preference shares, and the dividend isn't declared. So would we deduct the preference dividend when calculating our basic earnings? Okay, you are 100% correct. Because these preference dividends are cumulative, even though the preference dividend hasn't been declared, they will be caught up in the future. Okay, so yes, we would deduct the preference dividend. As you can see in scenario 3, they have taken profit for the year of 200,000 and they have subtracted the preference dividend. This is going to give us earnings attributable to ordinary shares of 192,000. Okay, so that is correct. Now, if we have cumulative and redeemable preference shares and the dividend is declared, So these shares are cumulative and redeemable, and the dividend is declared. Are we now going to say that these preference dividends should be deducted from our profit when we calculate our basic earnings? Okay, there are mixed answers here. We have some people saying yes, they should be deducted, and some people saying no. Remember that these preference shares are redeemable. Okay, these preference shares are redeemable. Okay, so these preference shares are going to be redeemed at some time in the future. So when preference shares are definitely going to be redeemable, remember there is an obligation. So these preference shares should be treated as a liability. So if these preference shares are treated as a liability, the dividend should really be treated as interest, or should be calculated using the effective interest rate method. So the preference dividends would already have been deducted when calculating profit for the year. So therefore, because the preference dividends were already deducted when calculating profit for the year, when we are calculating our basic earnings, they were already deducted. So do you agree we're not going to deduct them again? Okay, we're not going to deduct them again. So I'll just explain it again. So in scenario 4, we have cumulative and redeemable preference shares, and the dividend is declared. So where we have preference shares that are definitely going to be redeemed, they should be treated as a liability. So when we have a preference share that is treated as a liability, the preference dividends are essentially treated as interest using the effective interest rate method when calculating profit for the year. Therefore, the dividends have already been deducted when calculating the profit of 200,000. Okay, so we are not going to deduct the preference dividends when calculating our basic earnings, and the reason is that because the preference shares are a liability, the preference dividends would already have been deducted when calculating the profit for the year. So our basic earnings that is attributable to our ordinary shareholders is going to be the 200,000. Okay, so the question doesn't specify, but we would have to specify it in a test or exam more. But the question kind of indicates that they're definitely going to be redeemed. Okay, so then if we have a look at the next example, if we have a look at scenario 5 and we say the preference shares are cumulative and definitely redeemable and the dividend isn't declared, would we deduct the preference dividend when calculating our basic earnings? So we have cumulative preference shares, but remember these are definitely going to be redeemed and the dividend isn't declared. Okay, so it is similar to the previous example. The preference shares are redeemable and they're definitely going to be redeemed. Therefore, these should be treated as a liability. So the dividend should therefore be treated as interest and calculated using the effective interest rate method in calculating profit for the year, even if it is not declared. So therefore, the dividends have already been deducted in calculating the profit of 200,000 Rand. So you agreed that because this is a liability, because the preference share is a liability and is therefore going to be recognized as a liability, the preference dividend is already deducted when calculating the profit. So therefore, in order to get to your basic earnings, you're not going to deduct it again. Okay. So let's have a look at the calculations here. We said in scenario 1 that our preference dividend was deducted. And in scenario 3, where the preference dividend was deducted, and you can see how the preference dividend has an impact on your earnings attributable to your ordinary shareholders. Okay, so someone is asking, what if it's non-cumulative and redeemable and the dividend is not declared? Well, in that situation, if the preference share is redeemable and treated as a liability, then the preference dividend would already have been deducted. It would be like the same situation as example 4 and 5, okay? So it would be the same situation as 4 and 5. So let's have a look at the next slide. So now we have our basic earnings. We have our earnings attributable to our ordinary shareholders. So the next two slides really just explains what you guys told me. So it tells you in scenario 1 that the preference shares were non-cumulative. Therefore, the dividend was deducted as it was declared. Okay, so these are just the reasons to explain why we didn't deduct the preference dividend, or if we did. Then in example 2, remember the preference share was non-cumulative. Therefore, the dividend is only deducted when it is declared. And in example 2, it wasn't deducted because it wasn't declared. And then in example 3, we had the preference shares that were cumulative. Therefore, the dividend must be deducted even though it is not declared. So because the preference shares are cumulative there, the dividend must be deducted even though it was not declared. Okay. And then in the fourth and fifth example, the preference shares were redeemable. Therefore, they were treated as a liability, and the dividend should therefore be treated as interest and calculated using the effective interest rate method. Therefore, these would have already been deducted when calculating the profit of 200,000. So in both of these situations, because the preference shares were definitely redeemable, they would be treated as a liability. Therefore, there would be no deduction of the preference dividend. Okay. So then if we go to the next slide, this just shows the earnings per share under each of those scenarios. So remember, we calculated in scenario 1, the basic earnings was 192,000 and there were 20,000 shares. Therefore, the earnings per share would be R9.60 or 960 cents per share. Then in the second scenario, because the preference dividend wasn't deducted, the 200,000 Rand profit becomes your basic earnings, and this was divided by the 20,000 ordinary shares in issue, and that gives us earnings per share of 10 Rand per share. Then if we have a look at the third scenario, the preference dividend was deducted. So that gave us a basic earnings per share of 192,000 Rand. And we divided that by our number of ordinary shares being 20,000. And that gave us an earnings per share of R9.60. If we have a look at the fourth scenario, here remember the preference shares were definitely redeemable and therefore were treated as a liability. So we did not deduct the preference dividend. So in that case, our basic earnings per share was 200,000 Rand divided by our 20,000 ordinary shares, and that gave us an earnings per share of 10 Rand. And then it was similar for the fifth example. The preference shares were redeemable, therefore were classified as a liability. So in that situation, our basic earnings is 200,000 divided by 20,000 ordinary shares, and that gave us 10 Rand per share. Okay. So that was quite a big example. Okay, if you don't understand, go through it again in your own time and just read through the explanations and see if you understand. You could even use that diagram that we looked at the beginning. You can do this example again using the diagram on page 18 to assist you, okay? But let's move on now. We still have quite a few slides to go through. So far we have looked at the basic earnings per share calculation, and we have looked at the numerator being our basic earnings. But remember, we also have a denominator to consider. The denominator in the basic earnings per share calculation, the denominator is to calculate the weighted number of shares in issue during the reporting period. So now we're actually going to look at the denominator and see how to calculate that, because in some situations that the number of shares is going to change during the period, and therefore we will have to weight this to calculate the weighted number of shares in issue during the period. Okay. So weighted number of shares is sometimes abbreviated to WANOS. So when we're looking at our weighted number of shares, if there was no movement for the year, i.e. the number of shares at the beginning of the year was the same as the number of shares at the end of the year, then we are going to use the number of shares in issue at the end of the reporting period, okay, because it is the same at the end as it was at the beginning, because there was no issue of shares or no movement. Okay, someone has asked, the class will always take 2.5 hours. No, it will not. It really just depends on how long the topic is. This week just seems to be quite long, but maybe if we put our heads down, we can try finish as close to 12 as possible. Okay, I just made it that time in case it's over. But if it's a short topic, then it might take shorter to do, okay? So we said if there's no movement during the year of shares, the number of shares at the end of the period is the same as the number of shares at the beginning of the period, then you will use that number of shares when calculating your basic earnings per share. But what happens if there was a movement in the number of shares during the year? We need to adjust or weight the number of shares to calculate our denominator being the weighted number of shares in issue. So we use a time weighting factor to calculate the WANOS for the reporting period. Okay. So let's have a look at the next slide. So you'll see that often a company will issue more shares during the year. We can have an issue for value or an issue not for value. Okay, so we're first going to look at when we have an issue for value. When we have an issue for value, it means that these shares are paid for. They are issued in the normal way, where the shares are issued and shareholders actually pay for these shares. So let's first look at how to calculate the weighted average number of shares where we have an issue for value. Later on, we'll have a look at where we have an issue for no value and how it's different. Okay, so where we have an issue for value, if the issue is at the beginning of the year, the number of shares does not need to be adjusted. Okay, so if we have the issue at the beginning of the year, the increased number of shares is there for the whole year. So it is quite straightforward to calculate, because we will just use the number of shares at the end of the year when calculating our earnings per share. However, what do we do if the issue is during the year? So if 3 months into the year, the company decides to issue shares, we realize that the earnings potential of the company increases after the proceeds from the share issue are received. Okay, so what that means is when a company issues shares, the shareholders will pay for those shares and the company's share capital will increase. And now the company will take that share capital that was given to it by the new shareholders, and it will use that money to invest in its business and to increase its profits. Okay, so the whole point, when your share capital increases, you expect your profit to increase because you are using that money to build your company and to grow your company. So when we have a share issue during the year, the earnings potential of the company will increase after the share capital is received from the shareholders, from the new shareholders. So in this situation where we have an issue for value during the year, the number of shares needs to be weighted based on the time they have been in issue during the reporting period. Okay, so if shares were issued 6 months into the year, we are going to weight the new number of shares for 6 months. Okay, it sounds complicated, but it's actually not. Let's go to the next slide and see if we have an example or an explanation. So here it says the number of shares would be weighted based on the time they've been in issue during the reporting period. For example, if we have shares that are issued 5 months into the reporting period, then a time factor of 7/12 is applied. Okay, so how do we get 7/12? So if after 5 months, so we have the beginning of the year being 1st of January, and 5 months later, we have new shares that are issued. So how long do we have those new shares for in the current year? We would have those shares for 7 months, okay, because they were issued 5 months after the start of the beginning of the year. So we will go from 5 months to 12 months, and that's making noise. Please can you mute your mics? Okay, thank you. Okay, so it's important to weight it. It's almost like depreciation, where you have a new equipment during the year and you will only calculate depreciation from when you have that equipment. It's a similar principle here where you are calculating your weighted average number of shares. If the shares were issued 5 months into the reporting period, you only have them for 7 months of that year. Therefore, you need to weight it for 7 months because you only had the potential to increase your profit when those new shares were issued. So therefore, how many months in the year did you have those new shares for? And the answer here would be 7 months. So 7/12 is the portion of the period during which they are in issue. So the number of months after the shares are issued. So let's go to the next slide where we have an example, and you'll see that it's actually not as complicated as it sounds. So FAC3 had 100,000 ordinary Class A shares in issue during the previous year. There was a share issue of 100,000 ordinary shares on the first day of the current year. Basic earnings for the current year was 400,000. Calculate the basic earnings per share for FAC3 Limited for the reporting period ended 31 December 2012. So in this situation, who can tell me what the earnings per share is going to be? So this is an easy example. They had 100,000 ordinary shares, opening balance. Then they had a new share issue during the previous year. There was a share issue of 100,000 ordinary shares on the first day of the current year. So if the new share issue happened on the first day of the current year, it means at the end of the period, we had those new shares for 12 months. So we had 12 months to increase our earnings potential. So you are correct. So we have our opening balance. We have 100,000 shares from the prior year. Then on the first day of the current year, we had another 100,000 shares issued. So this was issued for the full duration of the current year. So it is basically like timesing it by 12/12. So in this case, our weighted average number of shares is going to be 200,000. And they told us that our basic earnings was 400,000 Rand. So we are dividing our basic earnings by 200,000 shares. That is going to give us 2 Rand per share. Okay, so here they are just showing you that the shares were issued for the full duration of the year. Now, when we go to the next example, we'll see that it's a bit different, and we can compare it to the previous example. So if you go to lecture example 5, here FAC3 had 100,000 ordinary Class A shares in issue during the previous year. There was a share issue of 100,000 ordinary shares on 30 October 2012. Earnings for the current year were 400,000. Calculate the basic earnings per share for FAC3 Limited for the reporting period ended 31 December 2012. So who can tell me here what our earnings per share would be? So here there was a share issued during the year. Okay, so let's have a look at the workings. So we have an opening balance of 100,000 shares. So they told us in the example that FAC3 Limited had 100,000 ordinary shares in issue during the previous year. So this means the opening balance is 100,000. There was then a share issue of another 100,000 ordinary shares on the 30th of October. So if those new shares were issued on the 30th of October and the year end is 31 December 2012, how many months did we have those new shares for in the current year? So the new shares were issued at the end of October. How many months in the current year did we have those new shares for? So the end of the year is 31 December. Those new shares were issued on the 30th of October. So we go November, December. So we had the new shares in issue for 2 months. So we are going to weight the new share issue. Even though 100,000 shares were issued, we only had these shares for 2 months. So we're going to multiply them by 2 and divide by 12. And this will give us 16,667. So when we calculate our weighted average number of shares, we're not taking the 100,000 and the 100,000. We are weighting the issue. We only had it for 2 months. So in this situation, our weighted average number of shares is the opening balance of 100,000 plus the new issue that is weighted of 16,667. This will give us 116,667 shares that we then need to use in our earnings per share calculation. So they told us our basic earnings per share is 400,000 Rand divided by our weighted average number of shares being 116,667, and this will give us 3 Rand and 43 cents per share. Okay, so I think you need to ask yourself, so if it is issued after the reporting period, well, do you mean in the current year? So someone is asking what happens if it is issued after the reporting period. Would it then be carried over for the next reporting period? I'm not sure I understand your question. Are you saying if it's issued in the current year? Okay, let's carry on. So have a look here. We have a column actual. So our opening balance is 100,000. And then we actually did issue 100,000. So in our financial statements, where it discloses the number of shares in issue, we would have 200,000 shares in issue. But for the purposes of calculating our earnings per share, we have to weight it. So in reality, we do actually have 200,000 shares in issue. But the reason we are weighting it here is simply to calculate our earnings per share. Okay, because our earnings per share is a function of our earnings and our number of shares. But if we divided the earnings by 200,000, it would make it very small. But we need to consider the fact that we only had these new shares in issue for 2 months of the year. So we only had the earnings potential for 2 months. Okay, so have a look at the actual column and the weighted column. We are using the weighted column to calculate our earnings per share. But in our financial statements, we would actually show we have 200,000 shares in issue. But for the purpose of calculating our earnings per share, we need to weight the new share issue during the current year just for our earnings per share calculation, because we need to show that we only had those new shares for 2 months, meaning we only had the earnings potential for 2 months of the year. Okay, let's have a look at the next slide. So we have looked for share issues where we had an issue for value, meaning it's a normal share issue. The company issues those shares. Shareholders will pay for those shares and take up those shares. So the company will be receiving share capital, okay? That is a for value issue. But if we have a look at another situation, sometimes we will have something called a capitalization issue or a share split. These will be issues for no value. Now we need to have a look at how to calculate the weighted average number of shares where we have an issue for no value. Who can tell me what is a capitalization issue? Who can tell me what is a capitalization issue? Okay, a capitalization issue. This is an issue of new shares to existing shareholders in proportion to their existing shareholding. So shareholders do not pay for these new shares they are receiving. So that is a capitalization issue. The current shareholders will each be issued new shares in proportion to the existing shareholding. In this case, the shareholders do not pay for the new shares they are receiving. Okay. Then we also have something called a share split. Does anyone know what a share split is? So a share split is when a company wants to increase the number of shares it has by issuing more shares to current shareholders. So for example, you may have a situation where a shareholder holds 1 share and then it is given another share to it in proportion, it is given another share. Okay, so for example, in a 2-for-1 split, additional shares given for each share held by a shareholder. Okay, so what's important to note is in both of these situations, it is an issue for no value. No money is going to be given by the shareholder to the company. So in this situation, there's no increase in resources and capital. So because we did not have an increase in capital, because these shares were not paid for, it means an increase in profits cannot be expected. So in the previous example where we had an issue for value, the shareholders paid for those shares, the company received the money, the company invested that capital into growing its business and increasing its profits. But here, because no money is received, no capital is received from the shareholders, it means profits are not going to increase as a result of capital, okay? So if the earnings remain the same year on year, comparability of information would be impaired due to the change in the denominator. So when we have an issue for no value, the number of shares is changing, but you cannot expect a corresponding increase in the profit. So we are worried about comparability. If we look at our earnings per share, we will see that comparability can be impaired because the number of shares have changed, but because it was an issue for no value, the earnings did not change. So in order to improve comparability, because remember when you think of the conceptual framework, we obviously want financial statements that are comparable. So in this situation where there's an issue for no value in the current period, the number of shares that appear for the prior year comparative must be adjusted as well. So even though this issue for no value will happen during the current year, we want the prior year in our financial statements to be comparable. So we will show the number of shares that was issued for no value. It must appear in the prior year as well. Okay. So if we have an issue for no value that occurs in the current period, there's no time weighting of the shares in the current period, and the number of shares in the prior period must be adjusted as well. So remember when we looked at an issue for value, we had to time weight those shares because we said that the earnings potential was there for only after the shares were issued. But here, because these are for no value issues, there's no increase in earnings potential. So we will not time weight these shares in the current year because they are for no value, there's no increase in the earnings potential. And then in order to have comparability, we are going to we are going to have the number of shares in the prior period must be adjusted as well. And this will facilitate comparability. Okay, so here this just explains it further, and then we're going to get to an example. So issues for no values, we said that an example of this would be a capitalization issue and a share split. No money is received from the shareholder. So the number of shares will increase without a corresponding increase in equity. Okay, so if you think of the journal entries, there's really no effect here. We are debiting retained earnings and crediting share capital. So the effect is actually, there is no effect. We are basically moving from one equity to another. Therefore, there's no increase in value. So therefore, as a result of it being debiting retained earnings and crediting share capital, which is both equity, no cash flow will result from the share issue. Okay, so let's have a look at the next slide, which is an example. Okay, let's have a look at an example and then I'll answer those questions. So let's have a look at example 6 on slide 39. So FAC3 had 100,000 ordinary shares in issue during the previous year. There was a capitalization issue of 100,000 ordinary shares during the year ended 31 December 2012. Earnings for the current and prior year were 300,000 and 400,000 respectively. Calculate the basic earnings per share for FAC3 Pty Limited for the reporting period ended 31 December 2012. Comparatives are not required. Okay, so think about this. What is your basic earnings per share in this situation? And it says comparatives are required. Okay. So let's have a look at the example together here. Okay, so it looks confusing, but let's have a look at it and break it down. So FAC3 had 100,000 ordinary shares in issue during the previous year. So if there were 100,000 shares in issue during the previous year, you agree our opening balance for 2012 is 100,000, okay? Then we have an issue for no value. So there was a capitalization issue of 100,000 ordinary shares during the year ended 31 December 2012. Okay, so it doesn't really tell us the date here, but they're assuming that there was a capitalization of ordinary shares during the year ending 31 December 2012, okay? So remember we said that there is no time waiting, so it doesn't suppose to really matter when it happened. So there's no time waiting here because it is a no value share issue. So do you agree when we have a capitalization issue, no share capital is going to be received? So we actually have 100,000 Rand, okay? There's no time waiting, so even if it happened in the middle of the year, we are not going to time wait it. So for 2012, the capitalization issue resulted in 100,000 additional shares. So even though this capitalization issue happened in 2012, we need to adjust our comparative figure when we calculate our earnings per share. So previously in 2011, obviously in the financial statements in 2011, we would not have recorded this capitalization issue. And that is correct because it didn't happen there. But in terms of calculating our earnings per share, we need to show the 2011 issue for no value as well as 100,000 in the prior year when we calculate our earnings per share. Okay, so even though this capitalization issue happened in 2012, in 2011 we also need to show the issue for no value when we calculate our earnings per share. So then when we look at our earnings per share in 2012, our basic earnings was 400,000. And for the prior year, it was 300,000. And we divide both of those by 200,000 shares to get our earnings per share. The reason that 2011 is the same as 2012 is because when we had that issue for no value, we wanted the earnings per share ratio to be comparable. So then we said when we calculate our earnings per share, we need to show the issue for no value in the number of shares as well as 100,000. Okay. If you have looked at the previous slide, it makes sense. Okay. So the previous slide on slide 37 says if there's an issue for no value in the current year, there's no time waiting of these shares in the current period, and the number of shares in the prior period must be adjusted as well. And this is to facilitate comparability. So that is what we have done here. There's no time waiting when the capitalization issue happened. And also we adjusted the comparative year for the capitalization issue that happened in the current year. Okay. So the earnings per share was 2 Rand in 2012 and 1 Rand 50 when we adjusted the comparative year of 2011. Okay. Let's move on to the next example and see if we understand this principle further. So in lecture example 7, it says FAC3 Pty Limited had 10,000 ordinary Class A shares in issue during the previous year. On the 1st of April 2012, 12,000 Class A shares were issued at 5 Rand per share. Then on the 1st of June 2012, there was a share split of 5 new shares for every 2 shares held. They tell us the basic earnings in 2011 and 2012 were 150,000 and 261,250 respectively. So there are 2 share issues here essentially. We have 12,000 Class A shares that were issued at 5 Rand per share. If they were issued at 5 Rand per share, is this an issue for value or for no value? So the 12,000 Class A shares were issued at 5 Rand per share. Is this an issue for value or for no value? Okay, correct. So the 12,000 Class A shares issued at 5 Rand per share, this is for value. But then on the 1st of June 2012, there was a share split of 5 new shares for every 2 shares held. So the share split, is this for value or for no value? The share split, is this for value or no value? Okay, you guys are getting it correct. This is for no value. On the 1st of June, there was a share split of 5 new shares for every 2 shares held. This is for no value. So now we need to calculate the basic earnings per share for FAC3 Pty Limited for the reporting period ended 31 December. Comparatives are required. So let's have a look at the scenario here. So what's important is that we need to do these share issues in order. So because the issue for value was done first, this is what we are going to look at first. So the opening balance was 100,000 ordinary shares that was given to us. Then we had an issue for value of 12,000 shares. So the actual number of shares issued were 12,000, but these were issued on the 1st of April 2012. So because they were issued on the 1st of April 2012, how many months do we need to include these shares in our weighted average number of shares? How many months did we have these 12,000 shares for? Okay, good. We had these 12,000 shares for 9 months. So for 9 months, we had increased our earnings potential. So what number do we need to include in our weighted average number of shares? So we need to weight this 12,000 and say, well, we had these 12,000 shares for 9 months out of the 12 months. So therefore, the weighted average number of shares is going to be 9,000. Okay. Then we need to look at the issue for no value. Before we look at the issue for no value, you need to calculate your total. So the total actual number of shares we had was 22,000. That was the actual number of shares that the company has. But for purposes of our earnings per share calculation, the weighted average number of shares is only 19,000. And the reason for this is that we had an issue for value, which we had to weight by 9/12. Okay. And in the prior year, we had 10,000 shares in issue, which comes from the opening balance. Remember, when we have an issue for value, we are not going to adjust the prior year. Okay. Then we need to look at our issue for value. So when we have our issue for no value, this happened on the 1st of June 2012. There was a share split of 5 new shares for every 2 shares held. So we need to now take this into account. So actually, how many shares do we have? So if we look at the actual column, we're going to take 22,000 and we're going to divide it by 2. So for every 2 shares held, 5 shares are issued. Okay. So when we look at the issue for no value, if you go 22,000 times divided by 2 times 5, you'll get 55,000 shares. This represents the total number of shares you have now. So for those 2 shares you held, now convert into 5 shares, okay? So the total number of new shares you have is 55,000. So in order to calculate the number of new shares as a result of this issue for no value, you have 33,000 shares. So here the calculation goes 22,000 times 5 divided by 2. You had 2 shares, now you have 5 shares. Obviously, you want to calculate the issue for no value, so you are minusing 22,000, which is essentially your balance just before the issue for no value. That will give you 33,000 shares, okay? This is the actual column here. When you're looking at the 2012 number of shares, we are looking at the column above the total above here. Okay, so remember the actual number is different to the weighted average number of shares we are going to use when calculating our earnings per share. So when we look at the issue for no value, how many shares did we have just before the issue for no value? According to our weighted average number of shares, we had 19,000 shares, and it was a share split, 5 shares for every 2 shares held. So we're going to multiply it by 5 over 2, and then that will give us 47,500 total shares, okay? Obviously, we want to know what the issue for no value is, so we will minus the opening balance of 19,000. That will give us 28,500 issue for no value shares, okay? So even though the issue for no value had happened on the 1st of June, remember, because there's no increase in earnings potential, we are not going to weight it. It is an issue for no value, so there is no time weighting over here, okay? And now remember, because it is an issue for no value and we want to promote comparability, when we look at our earnings per share calculation, we are going to adjust the prior year. So in the prior year, we are going to calculate our issue for no value by taking the number of shares just before the issue for no value, which was 10,000 shares, and we're going to multiply it by 5 divided by 2 because it was a share split of 5 shares for every 2 shares held. And then that will give us a total of 25,000. But obviously, we want to calculate the issue for no value, so we will subtract the opening balance of 10,000. Okay, so now we have accounted for our issue for value, which we time weighted, and we did not adjust the prior year. Now we have to calculate, and then we calculated our issue for no value. Remember, when we calculated our issue for no value, we did not time weight because there was no increase in earnings potential, and we had to adjust the prior period. Okay. Someone is asking, with shares issued for no value, when do we minus and add? Because in the previous example, we added, okay? But I think you have to ask yourself why we did that in the previous example. So in the previous example, we simply had our opening balance. I think you're getting confused here, but remember we had an issue for value, and then this became our new opening balance here. Here we are simply calculating the issue for no value. So don't get confused here. We are simply calculating our issue for no value. It was different in the prior example, okay? We didn't have a share split in the prior example. In the prior example, they just told us there was a capitalization issue. Here there is a share split, okay? So we want to calculate the issue for value. If we go 22,000 shares times 5 over 2, you had 2, now you have 5. That will give you the balance here of 55,000. But then they are minusing the opening balance of 22,000 here to give you 33,000. Okay, it's a different process. So have a look at the two examples and compare them, okay? So now that we have calculated our total number of shares, you can see the actual number of shares we have is 55,000, but according to our 2012 column that we need to use in our earnings per share, we have 47,500, and the difference mostly relates to the issue for value, where we time weighted it, and then that resulted in our issue for no value being different because these two balances here were different, okay? Then remember, because we had an issue for no value and we wanted our prior year to be comparable, we adjusted our prior year as well. So now when we calculate our earnings per share, we need to take our earnings per share given to us in the scenario For 2012, our basic earnings per share was 261,250 divided by 47,500 shares, and that will give us an earnings per share of R5.50 per share. Then for 2011, we had a basic earnings per share of 150,000 divided by 25,000 shares, and that will give you R6 per share. Okay, so in this example, we looked at issue for value and issue for no value. Remember, when you do this calculation, it needs to be in time, in order. If your issue for value happens first, you need to do that and then do your issue for no value. Okay. Let's have a look at the next slide, which just explains what I've said. So it says here, when there has been more than one movement during the year, the adjustments must be made in date order. And that is what we did. We had the issue for value first, and we did that. And then we calculated our total number of shares, and then only did we do our issue for no value. So it's important that it is done in date order. So the capitalization issue is adjusted for in the current period, as well as in the prior periods reported in the current period. Okay. This is talking about lecture example 7. I think it's actually supposed to be share split here. The share split is adjusted for in the current period, as well as the prior period reported in the current period, meaning the comparative year. The prior year financial statements are not restated. Only the comparative figure as it appears in the current financial statements is restated. So we're not saying that the prior year was wrong and needs to be restated. We're just saying that the comparative figure is going to be adjusted so that when you compare your earnings per share this year and last year, it is comparative. Okay. So that is lecture example 7. So if we go on now to lecture example 8, which I think might be the last one, let's have a look at lecture example 8. So FAC3 had the following capital structure. So someone is asking, just for interest's sake, why is it on the financial statements? It starts with the latest date, all the dates to the oldest date. Well, obviously for your financial statements, users are more interested in the current year column, and then the prior year is the comparative column. I'm not sure if that's what you're asking. Okay. So in lecture example 8, FAC3 had the following capital structure. At the end of the previous reporting period, 30 June 2012, we had Class A shares of 400,000 shares, Class B shares 200,000 cumulative preference shares of R1 face value each, and a 10% coupon payable on 30 June each year. On 1st of February 2013, FAC3 issued an additional 100,000 shares to its existing Class A shareholders as a capitalization share issue. On the 1st of May 2013, FAC3 issued an additional 30,000 Class A shares with a total value of 90,000. Okay, then they give us information. So they give us here the retained earnings for 2013 and the retained earnings for 2012. They give us an opening balance, a profit for the period, Class A dividend, Class B dividend, and closing balance. Okay, so they've given us this information. Then they've given us the basic earnings over here. Okay. So they calculated the basic earnings. Let's just see. So the Class B shares are cumulative preference shares. Okay, so when we have cumulative preference shares, remember that when we calculate our basic earnings and we have cumulative preference shares, these need to be deducted when calculating our basic earnings. So that is what they've done here, okay? So we have profit for the period, and they told us that the preference dividend, which is cumulative, is 20,000 Rand for 2013 and 2012. So when we calculate our basic earnings, we're going to take our profit for the period and subtract our preference dividends, which are cumulative, and that will give us basic earnings in 2013 of 1,262,000 and in 2012 of 900,000. Okay, so this is just recapping what we did earlier. We're taking our profit and we're stripping out any preference dividends that are there. These ones are cumulative, which means that they will be caught up if they are passed. Okay, so even if they're not declared, they are paid. But they did give us the Class B preference dividend here of 20,000. Then if we go to the next slide where we need to calculate our earnings per share, okay, we have an opening balance here. So we have just calculated our preference, we have just calculated our basic earnings here. So now we need to calculate the weighted average number of shares. They told us here that Class A shares had 400,000 shares, okay? Remember I said that your earnings per share, this is your earnings attributable to your ordinary shareholders. So when we calculate our weighted average number of shares, we are only going to look at our ordinary shares. We don't look at the number of preference shares here. We are simply looking at the number of ordinary shares. So we have our opening balance of 400,000. This is our opening balance. So the same in our actual, we actually have 400,000 shares in issue. In 2013, this is our opening balance as well as 2012. The first thing they tell us is on the 1st of February 2013, FAC3 issued an additional 100,000 shares to its existing Class A shareholders as a capitalization issue. So is a capitalization issue for value or for no value? So is the capitalization issue for value or for no value? Okay, it is for no value. So now when we take into account the capitalization issue, it happened on the 1st of February. But because it is for no value, there is no increase in earnings potential. So we do not weight it for the year. It is included for the whole year, okay? It is included for the whole year. And this is treated differently to a share split. So here they told us that the capitalization issue resulted in an additional 100,000 shares to its existing Class A shareholders. So they've given us the amount of 100,000 new shares, whereas in the previous example, where we had a share split, we had to calculate the number of shares for that share split. Okay, and this is different to a capitalization issue. So when we have a capitalization issue of 100,000, we are not going to time weight it because it is a not for value issue. There is no increase in profits. So we are going to include the full 100,000 shares for 2013. And remember, we want the prior year to be comparable. So even though the capitalization issue happened in 2013, for purposes of calculating our earnings per share, we need to add this in to the 2012 year. So we need to make it comparable, okay? Yes, so Bame asked a question. I just want to understand the addition of 100,000, must it be added in the previous for comparability? So yes, because for our earnings per share, when we're specifically looking at our earnings per share, yes, we need to add it in, because if we don't, then the prior year earnings per share is not going to be comparable. Okay, So it is only when there is for a no value issue, which is what the capitalization issue is. So the capitalization issue was for no value, meaning no time waiting, but we do need to add it into our comparative year when calculating our earnings per share. Then we have an issue for value. They say on the 1st of May 2013, FAC3 issued an additional 30,000 Class A shares with the total value of 90,000. So do you agree this is an issue for value? So because it is an issue for value, we need to time weight this issue for value. So actually, we had an additional 30,000 ordinary shares that were issued, but we only issued these shares on the 1st of May, and the year end is the 30th of June. So how many months did we have these new shares for? They were issued on the 1st of May, and the year end is the 30th of June. So we had these new shares for 2 months only. So we're going to take the 30,000 actual number of new shares issued, and we're going to multiply it by 2 divided by 12, because it is time weighted for 2 months, because we only had these new shares for 2 months. Therefore, it only increased our earnings potential for 2 months. So in 2013, the weighted number of shares relating to this issue for value is 5,000 shares. Because it is an issue for value and it increases our earnings potential and likely our profit, we do not need to adjust the comparative year because it is an issue for value. Okay, it will be comparative because we increased our number of shares in the 2013 year. Our profit is likely going to increase because it is an issue for value. So we do not adjust the comparative year. Okay, so remember here we are calculating our earnings per share. So we had our basic earnings previously here being 1,262,500 and 900,000. We did deduct our preference dividends here for our basic earnings. Remember, in this slide, we are simply calculating the weighted average number of ordinary shares. Our preference number of shares does not feature anywhere here. Okay, this slide here simply deals with our ordinary number of shares. So now that we have included our capitalization issue, which was for no value, and our issue for value, we can total this to get the total number of shares. So the weighted average number of shares we are going to use in our earnings per share calculation is 505,000 and 500,000 here. So when we do our earnings per share, we are going to take our basic earnings per share, which was calculated in the previous slide here. Remember, when you calculate your basic earnings per share, you subtract your preference dividend. In this case, it was cumulative, which is why it was deductible. Okay, so our earnings per share, when you take your basic earnings divided by your weighted average number of shares, that gives you R2.50 earnings per share for 2013 and R1.80 earnings per share for 2012. Okay, so that is this example. So it's important to look at the examples where you have an issue for value and an issue for no value, and you can compare and see how they are done differently. Okay. So this brings us to the end of earnings per share. We just have a few more slides to do on dividends per share. Okay, so dividends per share is very simple. It's not as complicated as the earnings per share, but you should have come across this ratio when you did financial statement analysis. So the dividends per share, this is a ratio used in the financial analysis of a set of financial statements. So to calculate how much has been declared to the shareholders, that is the aim of this ratio, to calculate how much has been declared to the shareholders. Unlike the earnings per share calculation, the number of shares does not need to be weighted for the dividends per share. So when you calculate the dividends per share, there's no weighting done. So it is much more straightforward, okay? So let's have a look at next slide, which shows a diagram. So when you calculate dividends per share, what are you actually trying to understand? So the best way to explain it is to go through this diagram. So what is the aim of any company? So here we have a company called Alpha Pty Limited. What is the aim of any company? The aim of a company for accounting purposes is to make a profit. So the company will undertake business activities to make a profit. A portion of that profit will be reinvested for more growth. A portion of that profit will be distributed to dividends, to shareholders through dividends, okay? So shareholders obviously supplied capital to start the company to do the business activities. So in order for shareholders to be compensated for the share capital they provided, they need to be paid dividends. So the ratio dividend per share is simply calculating the dividends paid to shareholders. So if we look at the dividends per share ratio, a company is required to disclose the dividends per share separately for every class of shares in issue. So for every class of shares in issue, we need to disclose the dividends per share. These need to be disclosed on the face of the statement of changes in equity or in the notes to the financial statements. The calculation to calculate our dividends per share ratio is dividends, like the total number of dividends, divided by the number of shares in issue. So remember, there's no time waiting. This will give us the dividend per share, which is what we want. Okay, so you're all on the same page. I'm quite certain you have seen this ratio before. Let's have a look at a simple example just so that we understand. So in example 9, FAC3 had 200,000 ordinary Class A shares in issue during the year ended 30 June 2013. An ordinary dividend of 80,000 was declared on 20 June 2013. What is the dividend per share for the reporting period ended 30 June 2013? Can anyone tell me what is the dividend per share? Okay, so you guys are all correct. So the dividend per share is calculated by taking the 80,000 Rand, which represents the total dividends, the total ordinary dividend that was declared, and dividing it by 200,000 ordinary Class A shares. So that will give us a dividend per share of 40 cents. You are 100% correct. Okay, so that was quite straightforward. Let's go to the next example where it gets slightly more complicated. So FAC3 had 200,000 ordinary Class A shares in issue on 30 June 2012. On 20 June 2012, FAC3 declared a final dividend of 20 cents per share. Okay, I think just check the date. I changed the date in the slide after it was put up. So this should be 2012. So on 20 June 2012, FAC3 declared a final dividend of 20 cents per share. There were no other dividends declared during the reporting period. So on the financial year end here is 30 June 2012 and 2013. So on the 1st of December 2012, FAC3 issued an additional 100,000 Class A shares with a total value of 120,000. During the year ended 30 June 2013, FAC declared an interim dividend of 24 cents per share on the 1st of March 2013, and a final dividend of 30 cents per share on the 20th of June 2013. So who can tell me here what the total dividends are? Let's break it down. So in 2012, there were 200,000 ordinary shares in issue. They declared a final dividend of 20 cents per share. So can you tell me what is the total dividend declared for 2012? So the total dividend declared for 2012 would be 40,000 cents. Okay, well done. You're all getting it right. So the total dividend declared for 2012 would be 40,000 cents. Then if we look at 2013, obviously in this year, there were two dividends declared. There was an interim dividend of 24 cents and a final dividend of 30 cents. So if we want to calculate the total dividends declared, it is 200,000, remember in 2013, there was an additional issue of shares. They issued an additional 100,000 shares. So in 2013, not only did they have the 200,000 shares, but they actually had 300,000 shares because there was a new issue. So in 2013, we have 300,000 shares times 24 cents, which is the interim dividend. That will give us 72,000. Okay, so in 2013, we issued more shares. So we had 300,000 shares, and the interim dividend declared was 24 cents per share. That will give us 72,000. Then we have 300,000 shares in issue with 30 cents per share. That will give us 90,000. I'm not sure if we're working in cents or rands here. Okay, we're working in rands. Okay, so that will give us 72,000 rand. And then when we have the final dividend declared of 30 cents per share, that will give us 90,000 rand. So the total dividend for 2013 will be 162,000 rand. Okay. So now using this, you can calculate the dividend. Well, here they actually do it the other way around. They're trying to trick you. So these amounts will appear in the retained earnings column of the statement of changes in equity. Okay, so this is an important question. Why wasn't the 100,000 shares added in 2012? Because according to the scenario, they bought the shares on December 2012. Okay, and the reason is that when we're looking at this example here, you need to look at the year end. So the year end 30 June 2012, what is the period for this year end? It will be the 1st of July 2011 to 30 June 2012. So that will be the reporting period for the year ended 30 June 2012. Whereas for the year ended 30 June 2013, the reporting period will be from 1st of July 2012 to 30 June 2013. So even though the issue happened on the 1st of December 2012, that falls into the year end 2013 because the year end for 2012 is 30 June. Okay, does that make sense? Okay, so it's important to look at when is the year end. So we're looking at the reporting period ended 30 June 2012 and 30 June 2013. So just make sure you ask yourself which reporting period does the new share issue fall into. Because it happened 1st of December 2012, this is after 30 June 2012. Therefore, it falls into the year end 2013. Okay. Okay, so you're all happy with that. So that is the end of dividends per share. As you can see, it is not as complicated as earnings per share. And one of the main reasons is that there's no time waiting for your shares when you calculate your number of shares. So the next slide, okay, we've gone through the solution. We simply took the number of shares multiplied by the dividend per share, and the required was to calculate the total dividends declared for the reporting period ended 30 June 2012 and 30 June 2013, which is what we did. So these amounts will appear in the retained earnings column of the statement of changes in equity. Okay, so that wasn't too difficult. So we've come to the end of the lecture on earnings per share. This slide just tells you about your homework. You have a tutorial and a practical question on this section. And this guy is saying, if you don't study, you shall not pass. Okay. So just remember to do your tutorial and practical questions and attend next week for your practical, and yeah, just engage with the session. Okay. That is the end of the session. You are welcome to leave. Someone is asking, must we do all tutorial questions for Unit 1? Yes, you must. Whatever we give you, you must engage with and do. Okay, that is it from me, students. You should be communicated with further for your tutorials. I think you may already have been. Yes, okay, this was a bit of a long lecture. Other weeks may not be as long as this, but it was a good start. Okay, thank you very much all for coming. Just to confirm, you don't have a practical today because we only did the work now. Okay, so your practical for earnings per share will be next week. Okay, thank you very much, everyone. Your tutorials should also start, the date will be communicated. Okay. Okay, bye everyone.